Most people think wealth starts with a lot of money, a high paying job, a successful business, a lucky investment, an inheritance, some big event that suddenly changes everything. But what if that's not how wealth is built at all? What if the biggest financial mistake people make isn't earning too little money, but underestimating what small amounts of money can become over long periods of time? Let's imagine something simple. Starting this month, you decide to invest $100 every month. Not because you're rich, not because your finances are perfect, not because you've finally figured everything out. You simply decide that every month, before that money disappears into random purchases and forgotten expenses, you're going to invest it. That's it. $100. Most people hear that number and immediately dismiss it because $100 doesn't sound life changing. It doesn't sound like the beginning of a wealth building strategy. It sounds too small to matter. And that's exactly why this conversation is important. Because almost everything that becomes powerful starts out looking insignificant. The first workout doesn't transform your body. The first page doesn't write a book. The first seed doesn't look like a forest. And the first $100 doesn't look like wealth. The first month passes. You make the deposit. Your account shows $100. Nothing about your life changes. You don't feel richer. You don't feel more secure. You don't suddenly understand finance better than everyone else. In fact, if you check the account a few days later, it might even be worth slightly less than what you invested because markets move every day. And this is where many people quietly give up. Not because investing failed, because it didn't feel exciting. The truth is that the beginning of investing is incredibly boring. Nobody talks about this. Financial success stories usually start with the ending: the millionaire, the early retirement, the impressive portfolio. Nobody tells the story of checking an account every month and seeing almost nothing happen. But that's what the beginning actually looks like. Month after month, the numbers move slowly. The balance grows, but not dramatically. And because humans are wired to seek immediate rewards, our brains start asking uncomfortable questions. Is this really worth it? Shouldn't there be more progress by now? Wouldn't this money be more useful somewhere else? These questions aren't signs that you're doing something wrong. They're signs that you're doing something difficult. Because investing requires a skill that modern life rarely encourages: delayed gratification, the ability to sacrifice a small reward today for a much larger reward tomorrow. And here's what's interesting: the first year of investing isn't really about growing your money, it's about changing your relationship with money. After 12 months, your account probably won't contain a life changing amount, but you've accomplished something far more valuable. You've proven to yourself that you can be consistent. Every month you made a decision and followed through. That might sound ordinary. It's not. Most people spend years waiting for motivation. Successful investors rely on systems instead. The difference between those two approaches becomes enormous over time. Because motivation comes and goes, systems stay. As the months turn into years, something begins to shift. You stop viewing investing as something you do. It becomes something you are. You become a person who invests, a person who thinks about the future, a person who understands that wealth is usually built gradually rather than suddenly. And then, just when things start feeling comfortable, the market reminds you that progress is never perfectly smooth. A correction happens. Maybe it's a recession. Maybe it's a market crash. Maybe it's just a period of uncertainty that dominates the headlines. Whatever the cause, your account balance starts falling. The same account that was growing now seems to be moving backward. And suddenly all those confident plans become emotional because losing money feels different than gaining money. Behavioral economists have studied this for years. People tend to feel the pain of losses more intensely than the pleasure of gains, which means even temporary declines can feel far more significant than they actually are. This is where many investors make their biggest mistake. They confuse movement with direction. The market moves down, so they assume the future is down. But those are two completely different things. Think about flying across the ocean. During the trip, the plane experiences turbulence. The passengers feel every bump. But turbulence doesn't determine the destination. It simply becomes part of the journey. Market declines are similar. They're uncomfortable, sometimes frightening, but they are not unusual. Historically, every major long-term period of market growth has included corrections, crashes, recessions, uncertainty, and fear. The people who ultimately benefit aren't the ones who avoid these periods, they're the ones who survive them. So instead of stopping, you continue. The automatic deposits keep happening. The habit remains intact. And eventually, something remarkable happens. The market recovers. It always feels surprising when it does, even though history suggests it shouldn't. The account reaches new highs. The losses that once felt permanent become temporary memories. And more importantly, you've learned something. You've learned that patience isn't passive. Patience is an active decision, a decision to trust a process despite short-term discomfort. That lesson becomes increasingly valuable as the years pass. Because after 5 years, something begins happening that wasn't visible in the beginning. Compounding starts showing itself. At first, almost all the growth came from your contributions. The money in the account existed because you put it there. But now the account is starting to help. The investments themselves are generating growth. Not enough to replace your contributions, not yet, but enough to notice. This is the stage where investing becomes interesting, because for the first time, your money starts participating in the process. Imagine pushing a heavy car. At first, all the effort comes from you. The car barely moves. Then momentum builds. The car starts rolling, and eventually keeping it moving becomes easier than getting it moving in the first place. Compounding works exactly the same way. The beginning requires effort. The middle rewards consistency, and the later years can feel almost unbelievable. Most people underestimate this because our brains naturally think in straight lines. If I invest $100 this month, then after 10 months I'll have invested $1,000. Simple, linear, predictable. But compounding isn't linear, it's exponential. And exponential growth is notoriously difficult for humans to intuitively understand. For years, progress feels slow, then suddenly it feels fast. The tree spends years developing roots before anyone notices its height. Compounding behaves similarly. The invisible years create the visible results. By this point, something else has changed too. Your relationship with spending. You don't become obsessed with saving. You don't stop enjoying life. You don't turn into someone who refuses every opportunity to spend money. Instead, you become intentional. You start recognizing the difference between spending that creates lasting value and spending that simply creates a moment. That awareness influences hundreds of decisions over a lifetime. And those decisions accumulate, not because you're perfect, because you're conscious. Years continue passing. The portfolio grows, the habit strengthens, the contributions continue. And eventually there comes a point where the growth generated by the portfolio begins approaching the amount you're personally contributing. Think about that for a moment. For years you were carrying the entire load. Now the portfolio is carrying part of it with you. Later, it carries even more. Eventually, the growth generated by your investments can exceed the money you're adding yourself. This is the moment many people finally understand why starting early matters so much. Not because early investors are smarter, not because they discovered a secret, because they gave time more opportunities to work. Time is the real asset. Money can be earned back. Time cannot. That's why waiting is often more expensive than making mistakes. People spend years preparing to invest, researching, planning, watching videos, reading articles, waiting for the perfect moment. Meanwhile, the perfect moment quietly passes by. Because investing isn't about finding the perfect starting point. It's about giving compounding enough time to matter. And the longer you stay invested, the more obvious that becomes. After decades of consistency, the numbers become impressive. But interestingly, the numbers stop being the most important part of the story. The real transformation happened much earlier. The portfolio is simply evidence. Evidence of discipline, evidence of patience, evidence of thousands of small decisions made correctly. People looking at the final result often assume there must have been a secret, some special strategy, or some hidden advantage. But the truth is usually much simpler. The secret was consistency. The advantage was time. And the strategy was refusing to quit. That's why the story was never really about $100. It was about what happens when ordinary actions are repeated long enough. Because wealth rarely arrives as a single event. It arrives gradually, quietly, almost invisibly at first. Until one day you look back and realize the small decision that once seemed insignificant changed the entire trajectory of your life. And that's the lesson. Not that $100 is magical, not that investing guarantees wealth, but that small actions become powerful when time is allowed to amplify them. Most people spend their lives searching for a breakthrough. Meanwhile, some of the most extraordinary outcomes are built from ordinary decisions repeated consistently for years. $100, 1 month, then another, then another. Nothing dramatic, nothing complicated, just a simple habit maintained long enough for time to do what time does best. Multiply the effects of consistency, and that's how wealth is usually built. If you got value from this video, don't forget to hit like, subscribe, and check out the videos I've linked here for you that will help you grow person and financially. Thanks for watching. See you in the next one.